Good evening, everyone. Time for another silver update. You're looking at the 30-minute chart, and you can see on this chart we still have the record of this volume spike that we had. Now, a lot of critics and commentators have said things about how this is not legitimate volume and that was a bad tick, and there's a lot of comments that have been made. I don't really have time to refute all of them statistic-wise because I don't have all of the volume information from the spot. If you look up here, you'll see this silver spot. This is not a futures contract. This is the silver spot, but it's very difficult to pull silver spot volume. Barcharts.com has it, but it's really difficult. I'll show you on a commodities futures chart, or commodities charts.com. This is today's futures volume. Now you can see the cash market, and that's something you need to understand. It's the difference between the cash market and the nearby futures contract. Now there are these untraded, very low volume markets that you have, the SIN, the SIQ, but the SIU is the primary silver futures market. The most active live nearby contract is the September futures, and you can see for today we did 65,000 contracts. Now you can see also we have an open interest of 60,000, so that's a pretty big churn. But back to the chart, so you can see that this roughly equals that volume, but I don't have the cash volume. So this, I have no reason to doubt that this is a legitimate volume move, and all you really need to do is look at the price action and the volume, and you can see that obviously with the price move and the volume that this is a real number. Now I'm going to request that people who have the volume numbers that have better sites than I do provide them, because I don't have time to go into it right now. I have more important things to talk about, but I wanted to explain briefly how these markets work and why you get things like the anomaly that you see here, which is the price drop occurring here and the volume essentially coming in right about here. Now, you know, if you've been in the markets, I've been a Series 7 stockbroker as well as a commodities broker. And if you trade these markets, you know that you have, for example, in the New York Stock Exchange, that you have the specialist's book. The specialist is a person who has a book on a stock. Basically, he has a book that contains all the open buy and sell orders for that stock. When you see a stock open on the New York Stock Exchange and it's halted, often they're halted for news items or earnings releases or things like that. That's because sometimes a specialist's book is out of balance. What that means is that if you had a tremendous sell order, a tremendous buy order come into the specialist's book, he's going to have to balance his book. Now that's similar to the computer traded markets that you have on the futures exchanges, but it's not exactly the same. It's somewhat similar, but you have floor traders in the futures who are not supposed to have information. They're not supposed to be able to front run the orders that are coming in, but for the most part they know that information. So to understand how this works, you have to understand how stop orders work in markets. You have two primary kinds of stop orders. You have a stop limit order, and that would be a person who says, for example, who recently went long silver, and they set a stop limit order of, let's say they set a stop limit of $40. So what they're trying to do is get out at $40 if the price crosses $40. So in this scenario, a person with a 40 stop limit would have sold out right there at that point. When the price traded at 40, their order would have been executed and they would have been taken out of the market. Now that's a stop limit order. That's not the same as a stop order. A stop order says that if the market price trades below the stop, then I want you to take me out at the next executed price. So that's very important for gap analysis and for the fills that occur, because when you have a tremendous sell order like this order that came in right here, when you have gaps in a market like we had in the flash crash or in other gapping markets, stop limit orders aren't going to be filled. So in this move here, where you might have had a person with a stop limit at 39.80 or a stop limit at 39.60, there's a good probability that those stop limits were not filled. Now, the stops themselves are going to be filled. So if it gapped from, say, 40 to 39.40, as soon as the next trade occurs, the stops are going to be filled, because their execution order says, get me out at the next traded price when it trades below the price I've set. So the reason why I'm explaining this is that this explains why you have on the New York Stock Exchange with the specialist book, you have orders that are halted so that the specialist can balance his book. In computer traded markets like these, you have the floor traders who will pull their bids. The way that works is if you have a bunch of floor traders who have clients who have bids, say, here and here and here and here. If they get wind, they're not supposed to, but of course they always do, but if they get wind of this type of a sell order coming in, what they can do is they can pull their bids. And they know a big sell order is coming down. They're not going to bid on a price they're going to get pushed through. They're going to try to bid and get the lower price. So it's not unusual at all to see these gap type moves because the buyers pull their bids and they wait for a settlement price. So when the market price drops far enough to find enough bidders to fill an order this large, then it's not unusual to see the price stabilize. Now, the price didn't stabilize. You can see it actually fell more, but they dropped it far enough to get enough bidders to fill those orders. So that's why the markets trade the way they do, because the bidders know when a huge sell is coming, and of course they're going to buy at a cheaper price if they can, and through collusion they're going to pull their bids en masse, and that's going to cause a tremendous collapse. Often it causes a gap down, and when it causes a gap down, obviously the sell stop limit orders are not filled, and the stop limit orders are filled at a much lower price. So you might have gone long silver and been afraid of some huge smackdown coming, and if you put in a stop order, you might have had a stop order at about 39.90, but you might have been filled at about 39.20 because the market, and if you look closely at the disclaimers in the markets, they talk about fast markets. There's no guarantee of fills in fast markets. So when you have a fast market, you're not guaranteed a price. So that's the floor versus the street, and you have to know how futures markets work. But I wanted to segue into the fundamentals of the silver market and why this volume is important. And I'm going to show you a couple of things I pulled. If you remember, I showed you the spot silver and the cash silver. Now, unfortunately, we have a zero volume on the cash, so that's why I've asked people who have better cash volume than I do if you can pull that. But you can see the nearby SIU 11 is the most actively traded futures contract, and you can see today it traded 65,000 contracts. Okay, so we're going to compare and contrast the silver contract versus the oil contract. And if we look over at the oil contract, you can see that the oil contract has the September contract, and then we actually have a decent amount of volume going out to January and February and March. So this is the volume of the oil contract. Now, if you look up the crude oil futures, if you go to, well, the COMEX has it, but this is a good site. I'll link this site. This gives you the light sweet crude oil contract, and it explains to you how this works, what the volume is. One contract of this futures is 1,000 barrels of oil, and that's light sweet crude. That's WTI. That's the contract that you see traded here. So what I want to do is to do a comparison of the volume in the light sweet crude versus the volume in the nearby silver contract. So when we go out to the daily, you can see that the spike top here that occurred, I think this, I'm not sure if this was the SPR release. I think we hit it, actually it was there. So this might have been front running, but we hit 89 and I got a buy signal right after they announced the Strategic Petroleum Reserve release. And obviously, according to the principle, if governments go one way, you go the other way. So this is a huge buy at that SPR release. But anyway, you can see the volume that we're trading at. And as I said, as I showed in the contract for crude oil, you've got 1,000 barrels, and the volume is, there's 150,000 spike. So what I wanted to do is to look at the amount of oil that's used in a day and compare that to silver. The reason I'm doing this is because I want to establish the relative price determination in the futures versus the cash market. So I've got a page here. This is actually a spreadsheet, and this is a link. I'll link this. This is from the, actually from the U.S. government, but this is the Energy Information Administration, and this is petroleum usage, and it goes by quarters, and then it goes by the most recent, and we have 2010 at the most recent one, and you've got, this quote is in million barrels per day, and we're at 87 in the third quarter of 2010. I'm using a rough estimation. It may be a little high, it may be a little low, I'm not sure, but I'm going to use 100 million for the third quarter of 2011 based on the increased usage in China and India. So we're going to say that basically this is usage per day of oil. This is world oil demand. So the world oil demand per day is roughly 100 million barrels of oil per day that this commodity is used up. So what I did was I created a spreadsheet which does a comparison side by side of silver and oil. Now, the oil contract, you can see here, is roughly, this is in thousands, so that's 5 million barrels. And you've got 4 million there. So you might have 20 million. I just used the daily. But if we go to this chart, you can see that I put 20 million in as the daily futures volume of barrels of oil that are traded in a day. So the world uses 100 million barrels of oil a day. The oil futures contract trades 20 million barrels of oil a day. That means that the futures is 20% of the daily usage. So that's a market that's dictated by the spot price, a market that trades based upon the daily usage because the futures amount is only 20%. Now let's look at silver. What I did to get the silver numbers is I divided by the yearly mining supply of physical silver, which is roughly 750 million to a billion, give or take, whatever you want. I use 750 million. And if we divide that by 200 or 365, we get roughly 2 million ounces a day. 2 million ounces a day is the amount of silver that is used up every day, in whether it's industrial or the vast majority is industrial, but there's also investment and jewelry demand. Now the other column is the volume of silver traded per day, and I got that from this number, the 65,000 contracts, and there are 5,000 ounces in each contract. So the number of ounces that are traded per day of silver comes to 325 million ounces of silver is traded every day, even though only 2 million ounces of silver is actually consumed per day. So that figure is 16,250%. So oil, only 20% of the amount of oil that's used every day is traded on the futures exchange. In other words, paper oil. But with silver, 2 million ounces of physical silver is used per day, but 325 million ounces of silver is traded every day, 16,250%. So these numbers are accurate. I've examined them. I don't see any reason to doubt these numbers. If you have better numbers, go ahead and provide them. But this is a comparison of how the silver market is at least 1,000 times, or nearly 800 to 1,000 times more manipulated than the oil market. The silver market is nearly 100% determined by fake silver that does not exist, while the oil market is 80% determined price by real oil. So as we go back to the chart, we can see that as we come close in, the spike we had here, it's showing on the 30-minute as above 60,000 contracts. That's because as you go further out, there's more, it compresses, so that's normal. On the 15, it's above 50,000, and that's another criticism I had. You have to understand the relative value of these. At 10 minutes, we're still above 50,000. At 5 minutes, we're just about 40-something thousand. So this spike is a real spike, and it's 250 million ounces. For that to be the equivalent of oil, 250 million ounces traded in a day is 100 times the amount of silver used in a day. So for oil, that would mean that the oil market, which uses 100 million barrels a day, would have to trade at 100 times that in a day, or 10 billion barrels of oil in a day. I don't even know the numbers. You do the math. The point is that silver is the most manipulated market on the face of the earth. 99% of the silver that's traded every day does not exist. Just like this silver that was sold yesterday did not exist. The people that sold this silver didn't have the silver, because 99% of the volume of silver traded every day is silver that does not exist. So I highly suggest that you buy silver that does exist, that you take delivery of physical silver, and make sure that you have it in your hands, because this silver doesn't exist. And when this market blows up, which it inevitably will, because markets are greater than governments, then this price is going to go at such an astronomical rate that you won't believe your eyes. But hopefully you'll have physical silver, and we'll talk to you next time.